Picture this, May 6, 2010. It's exactly 2:42 p.m. in New York. A top trader at a major hedge fund, let's call him JK, is about to make a move. This guy is a big deal, managing billions daily with complex algorithms designed to skim tiny profits off the market. The day started quietly. The market was stable, no bad news, everything was calm. JK sips his coffee, confident. He's about to execute a trade he believes is a sure thing. Minutes later, his algorithms kick into gear, executing thousands of orders per second. Green numbers flicker across his screens. He smiles. This is just another Tuesday. He's a master of this universe. But then, at 2:45 p.m., the first crack appears. A massive, unrelated sell order from another fund hits the market like a shockwave. The algorithms, which only understand numbers, not context, react instantly. They see the downward pressure and start selling too, amplifying the movement. Prices begin to plummet. JK's beautiful green numbers flip to a horrifying, flashing red. By 2:50 p.m., the margin calls begin. The once calm trading floor is now a scene of controlled chaos. In just 28 minutes, the fund loses a staggering $200 million. JK, once so confident, can only watch as his position, his reputation, and a fortune evaporate in real time. This wasn't just bad luck. It was a perfect storm of overconfidence, too much leverage, and a complete failure to imagine the unthinkable. This brings us to our first major lesson from the history of financial disasters. Leverage can destroy. Even the most advanced trading systems are not foolproof. Using high leverage is like adding rocket fuel to your car. It can send you flying, but if you crash, the explosion is catastrophic. For everyday investors, platforms like Interactive Brokers or TD Ameritrade have tools to help you monitor your margin requirements and overall exposure. Use them. Understand them. Don't let leverage turn a bad day into a financial apocalypse. Now let's jump forward a couple of years. It's 2017, and the world is going crazy for cryptocurrency. In California, a software engineer is watching Bitcoin rocket past $19,000. Like so many others, he'd poured his savings into it, convinced the boom would never end. His digital wallet was glowing green, showing life-changing, unrealized gains. He was already dreaming of what he'd do with the money. But then, news broke from South Korea and China. Regulators were cracking down. The market shuddered. Prices fell, then fell faster. Panic selling spread like a virus across exchanges worldwide. Within weeks, the engineer's portfolio, once a symbol of his genius, had lost more than 80% of its value. The dream was over. This leads us to lesson number 2, and is one of the most important in all of finance. Never invest money you cannot afford to lose. It sounds simple, but emotion and FOMO can make us forget. This is also where diversification becomes your best friend. Don't put all your eggs in one basket, especially a highly volatile one. Modern platforms like Wealthfront, Betterment, and M1 Finance make it incredibly easy to spread your investments across different assets, from stocks and bonds to real estate, mitigating the shock if one market implodes. But what if you are in a volatile asset? That brings us to lesson 3, have an exit plan. Before you even buy, you should know at what point you will sell, both for profit and for loss. Don't wait for a crash to decide. Use the tools available to you. Exchanges like Coinbase, Binance, and Gemini offer automatic stop losses and conditional orders. These can trigger a sale automatically if the price drops to a certain level, protecting you from catastrophic losses before they spiral completely out of control. Hope is not a strategy. An exit plan is. Let's rewind to the turn of the millennium. It's March 2000, the height of the dot-com bubble. A young investor is riding the wave, his portfolio packed with hot internet startups. The Nasdaq index is hitting new highs almost every day. It felt like a new era where the old rules of finance no longer applied. Fortune seemed not just possible, but inevitable. Then the bubble burst. Suddenly, the market woke up and realized that many of these companies had flashy websites, but no actual revenue, no profits, and no path to get there. Investor sentiment didn't just shift. It did a violent 180-degree turn. Stocks that had seemed invincible just weeks before began a freefall. Within months, our young investor's portfolio had collapsed, losing over 70% of its value. He learned a hard lesson that day. Lesson number 4. Growth does not equal safety. Just because a stock is going up doesn't mean it's a good company. High-growth stocks can be exciting, but they can also be incredibly risky. It's crucial to look at the fundamentals. Does the company make money? Does it have real revenue and positive cash flow? Focusing on these metrics reduces your risk. For most people, a safer way to get exposure to the market is through diversified ETFs and index funds, like those offered by Vanguard and Fidelity. You get the growth of the market without betting your entire future on the next hyped-up startup. Now for a story about a whale. Not a real one, but a financial one.